Financial Tip Tuesdays. Today we are going to talk about how to effectively tax plan. And as it gets closer to the end of the year, it's important to start to plan for what your taxes are going to look like going into preparing your tax return before April 15th, so you're not hit with a huge surprise tax bill. So some of the main things that we're going to go over are some of the new laws that came to light through the new Trump administration's tax laws. And so we're just going to highlight a few of those things and then talk about how you can kind of calculate your own tax return to see if you need to make an additional payment at the end of the year in order to catch up. So the first and one of the biggest changes is with the standard deduction versus the itemized deduction. The standard deduction for if you were single went from about $6,000 up to $12,000, and it also doubled for married filing joint people. It went from about $12,000 up to about $24,000. So that was a really big change in the tax law. Another big change is with the child tax credit. That also doubled. It went from $1,000 to $2,000. But another big change was with the exemptions. The exemptions were taken away. So you no longer get the exemptions from the individuals in your household, which was just over $4,000 per person. So that kind of, or per exemption. So that kind of, that hurts a lot of people. But the increase in standard deduction, along with the lower tax rates and the lower tax brackets that we'll talk about in a little bit, kind of tend to net that out in some ways, and it's more effective for some people and less effective for other people. But some other big things is that some other big things that changed along with the standard deduction was what you can actually itemize and what you can't actually itemize anymore. So along with the doubling of the standard deduction, when it comes to the itemized deductions, your state and local taxes that you could pay in is actually capped at $10,000 now. Another thing is that charitable contributions, you can actually have more charitable contributions, so that might help if you donate to a church organization or something like that. If you want to double up one year and then not do it the next year, you can actually take a more significant charitable contribution. So there's some strategizing that you can do there to get more effective tax break. But something that is very important to watch, especially if you're an employee of a company that you buy a lot of your tools or you buy a lot of your own things that you then take and deduct on your tax return, you're no longer able to do that. So the unreimbursed employee expenses goes away, along with a lot of the casualty losses and stuff like that, and like tax preparation fees. You're no longer able to take those as the miscellaneous deduction. And so for the new tax rates this year, they took the brackets and they actually made them wider, along with lowering the tax rates. So there's a lot of other brackets before this one that are on the actual brackets, but I started at 22%. First off, because I couldn't really fit them all in here, but also most people are affected around the 22% rate. So at 22%, if you're single, that's just over $38,000. And 77.5 for married filing jointly. And then when you hit 24%, it's 82,500 for single individuals, and then up to 165,000 for married filing joint is when you hit that 24%. And then when you hit 32%, that's 157.5 if you're single, and 315 if you're married filing jointly. And then when you hit 35%, that's $200,000 a year for the single, and then $400,000 for married filing jointly. And you actually can go all the way up to a 37% tax bracket, which that doesn't kick in for married filing joint until about $600,000 of income. And so what's important to think about as you're planning for your taxes is you want to take your wages or income that you earn from your businesses or whatever income that you had during that year. And these are some of the general things that you can take out of that number in order to come to what's called the adjusted gross income amount, which is then calculated at your specific tax rate. And do remember that these are marginal tax rates. So if you're in the 32% tax bracket, the income up to $38,000 is 22%, and then the income up to $82,000 between those two is at 24%, and so on and so forth as you're going to calculate your taxes. And it is important that you also look at the amount of money that you've already paid into the government throughout the year. So if you're a W-2 employee, you probably have withholding on your W-2 that is money going into the government, both the state and federal government, in order to pay off those taxes. So keep an eye on that as you're going through to plan for how much you're actually going to owe at the end of the year. So make sure you're taking that into consideration. And also make sure you're taking into consideration the new capped $10,000 for the state side if you're going to try to prepay more of your state taxes and stuff like that. So this is a very quick and dirty wrap up of how you can kind of plan for the new taxes coming up this year. If you have any questions, please reach out to me. My name is Stephen Gabrielson with SLG Advising. I'd love to talk to you about your situation and how you can kind of plan for the future and going into next year. I know there's been a lot of confusion with this new tax bill, so please reach out to your tax professional or accounting professional to help you walk you through it. I hope you guys have a great day. Tune in next week for another fun Financial Tip Tuesdays, and I look forward to hearing feedback from you guys on what you think of this video. Thanks, guys.